Hello, everyone, and welcome to Pring Turner's 2025 Summer Client Event. Whether you're joining us live or perhaps you're watching this as a recording, we are so grateful for you and grateful that you're here and excited to get started. Now, before we dive in to the actual event, just a couple housekeeping items. First and foremost, all of the ideas and opinions shared today is for informational purposes only. This is not specific investment or portfolio related advice. As well, the opinions and thoughts of the presenters today will likely change over time, just as the financial markets and related factors change over time as well. And secondly, feel free to chime in with your anonymous questions throughout the event, or you could save them and share them at the end. You can use the Q&A feature, which is located at the bottom of your event window, or you can use the chat feature, which is to the right-hand side of your event window. And we look forward to answering as many, hopefully all of them, at the very end. Now with that, let's get things started. We're going to answer some of the key questions that kept coming up from you, and some of those being, are we headed for a recession? Will the high market volatility continue? And what are key market indicators signaling today? And then last but not least, what is our proactive plan to protect and grow your wealth? Now with that, I'm going to pass the mic on over to Joe.
Thank you, Pamela. I have been assigned by the team for today's presentation to talk about the origin story of Pring Turner. And that is, how did we get started? And what is the process? And how do we make decisions in your portfolio? I have 12 minutes, 10 to 12 minutes they've given me to explain how all of that has developed in the last 55 years. Because next month it will be 55 years I have been involved in financial markets. And we'll start out with that definition. What is a process? And it is simply the steps or the actions that one takes to get a desirable outcome. When I started out, actually it goes back to college days when I took an investment class, and the professor gave us $10,000. I built a portfolio. I actually came in second in the class contest, and my methodology was I looked at the last page of the Wall Street Journal, and there's a little section called most active stocks. So there were things like electronics, associates, there was Memorex, Xerox, and those companies were really moving. So that became my stock selection method. And that started the myth or the belief that I had that I was one of those rare breeds of being a natural born financial genius. Fast forward after that, it took me getting into the industry, which I did in 1968, went through a training program for 6 months in San Francisco, got out of the training program and went to work. And my timing was impeccable because the stock market, the Dow Jones Industrial Average, topped out in December of 1968. It touched 1,000. It did not see 1,000 again until 1982. And that started as I realized quickly that I was not a natural born financial genius. I was going to have to go to work. And fortunately, there were some mentors that helped me along the way. There was a fraternity brother whose father had an office upstairs on Montgomery Street, and his name was Barney. Gave me a book, said, "Joe, read this book. It'll probably help you in your career a lot." And of course, at that point, I was still pretty smart and didn't need any stinking books to help me. As it turns out, my first few months, my first year or two experience in the market was, I need help. That particular gentleman called me up a couple of years later as I was in the middle of my search. And he said, "Joe, would you like some old papers that I've got on investing?" And I said, "Sure, Barney." And he said, "Well, bring a station wagon because I've got a few boxes." At any rate, I had a huge history of reports, journals, collection of Barron's Financial Magazine going back to 1937. That was a period of learning and pulling in and asking questions. And where we pull it together is in our decision-making process. So Pamela's put up here an inverted pyramid, and this is basically how we take information and filter it through. So there's like a timeline, if you would. We look at the secular outlook, the 10 or 20 years. For example, when I jumped into the markets, the stock market went down for 14 years. If we look at interest rates, what peaked out in 1981, they basically dropped for all the way to 2020. So we had a huge period of time, a secular period, where interest rates went down. Inflation has been low until recently, and I believe we've probably started a new secular upswing in inflation and commodity prices. We have broken down, and probably the key to the decision-making process starts with our analysis of where are we in the business cycle. And currently we're in business cycle number 35, and that goes back to the 1850s. So if you do a little math, the typical business cycle lasts about 4 to 5 years. Martin will give his views of where we are. He's the business cycle expert. He's been doing that for almost as long as I have, and also help us identify what stage we are in, yeah, in terms of the business cycle, early, middle, late, because that's going to help us determine where we want to emphasize certain assets in your portfolio. What sort of sectors do we want to de-emphasize or emphasize? And then we go further down in our timeline because probably every, maybe 2 or 3 times a year, we will get a significant move in the market that's worthwhile paying attention to and making some pretty good adjustments in your portfolio. And we describe that as intermediate moves. Maybe they're 10 to 20% in nature. And like I say, we do get a number of those, 2 or 3 a year. We have devised something called the fuel tank that helps us observe when the tank is getting full or empty, and we want to start taking actions to that. And then finally, what came out of all those books that I inherited and magazines was research that came through those journals that really pointed out if you want to manage risk well, and that is the name of the game, is emphasize quality, and there's a way to measure quality, value, and income. And that's the area that is in your portfolios. And that creates the eventual level of the portfolio. So let's now look at another way of analyzing or looking at the process and the disciplines. And we start out here with what we call macular or secular influences, which we've talked about. We next look at business cycles. Again, what is the thing that's going to help us in terms of allocation? We then go to looking at fundamentals of companies, fundamentals of the economy, of industry groups, of company potential investments. And then we look at technical, which technical is just looking at price. Fundamentals is what it is about the company or the industry that we should know, management, sales, that type of thing. Technical relates purely to the price action of the investment that we're looking at. And we want to see a favorable outlook, if you would, for the technical. And then the last piece that goes into the portfolio discipline and process is sentiment. And I have often thought this is a missing piece, or where most people miss making decisions and using in the discipline is checking sentiment. Because I think in almost one way that I've learned through studying markets, a successful investor might study psychology rather than economics. So these are the things that will all come together in terms of a discipline and a process that will be the recipe for investment success. So the The last thing I want to talk about here is pulling all these together, and let's just look uh, at the situation today and just make this a summary of bringing all the origin pieces and the pieces of the puzzle that we put together in looking at today's outlook. So in summary, let's look at the secular outlook. We definitely have a social phenomena called populism, which is essentially the workers or the general population versus the elites or versus the government or versus the deep state. And surely we see that in our government at work today, but it's also a global phenomena. Fiscal dominance is something we haven't heard much of, but it is definitely affecting financial markets today. There are two levers that the government basically has to manipulate or to move the economy along. One is monetary policy, and that's under the purview of the Federal Reserve. They affect interest rates or money supply, things like that. The other side comes from fiscal policy, which is up to the administration and Congress, and that's spending money, tax policy, running deficits or surpluses. But we've hit a situation today where fiscal dominance basically, I believe, is going to handcuff the monetary authorities, and it's going to create a little bit more, a lot more volatility, and also, I believe, inflation, because the government or the Federal Reserve, because of the debt that's grown out of fiscal irresponsibility, I'll call it, has really handcuffed the Fed in terms of what they can do to raise or lower interest rates. So that's a big issue that will seep into the picture. Maybe we don't measure it day to day, but it's definitely going to have a secular influence on the markets. So the next aspect that we're going to look at is business cycles. Like I said, we're in business cycle number 35, going back to the mid 19th century. Right now, the Federal Reserve is on hold because of what we are seeing from the Federal Reserve, from fiscal dominance, from all the changes that are going on in the populist movement and how the government we're going down things we haven't paths that we haven't tried before, or if we did, it was 100 and some odd years ago. So expect more volatility out of the business cycle and out of the markets. So then the next tranche to look at, we are looking at a market, a stock market, whose overall is overvalued, overbelieved, and overowned, which makes a challenge for us as managers to create returns. So uh, it's something that we're very much aware of, and it's going to be a bit of a headwind for the markets, uh, in the next few business cycles. But the fact is, there's always opportunity out there. And one of the things that we see that really comes to the Pring Turner methodology is that there's opportunity in value stocks. So going on to the technicals, we do have long-term momentum, Mo, in the financial markets has started to slow down. We've had a wonderful 15 years ever since the 2009 recession, I'm sorry, the 2020 low, and also 2009 lows. But we're starting to see that momentum slow down a little bit. The good news is we're still in an intermediate, that 2 to 6 month uptrend that started right there in early April. So that's the technical, the picture that we're looking at. And finally, if we look at sentiment, this is going to be the key for Pring Turner to try and create or manufacture returns out of what we think is going to be a volatile, uh, challenging markets looking forward. So that is the basic essence that I have about the origin and putting the pieces together and how and why you have a portfolio management process that's all geared to managing risk or keeping risk low. And if we do a good job there, which we have done for 50 years, then the miracle of compounding can happen. So with that, I'm going to pass this baton on to Martin Pring, who's going to bring us more up to speed with um, the business cycle, the outlook, the market outlook for that, and the stock market. So I'm going to sign off and turn this over to Martin.
Thank you very much, Joe. In 1988, Robert Colby and Thomas Myers wrote a book called The Encyclopedia of Technical Indicators, Technical Market Indicators. And in that book, they tested just about every indicator known to man at the time and came up with a solution with the best indicator of the ones they tested was a very simple one. It was a 12-month moving average crossover. So the price goes up, comes down, crosses below the moving average, and that's a sell signal. And the market goes down and comes up, crosses its moving average, that's a buy signal. And I've watched that indicator, or the 12-month moving average, for many years. And I'd like to talk a little bit about it today because it's very relevant for what's just happened to the market. So this is the S&P in the upper window, and the red line is the 12-month moving average. And I did some research on 12-month moving average crossovers back to 1959. And what I found, there were really two possible outcomes when you get a negative crossover. The first is what happened in early 2000, and that was that we had a bear market. So the price comes up, it crosses below the moving average, and it doesn't go back above the moving average until after the bear market's over. We had 13 instances of that. 11 of the instances when the market crossed below its 12-month moving average, the price continued to work down until the end, until the bear market was terminated. And that's what happened. That's what happened in most of these situations, as you can see here. We just got the last 20 years or so of this study. So that's one thing that can happen. It's going to be a bear market, and you don't get out of the bear market till you cross back above the 12-month moving average. The other is completely different, and that occurs during a bull market when we get a whipsaw signal where the market goes below the average and then doesn't stay there for more than a month or two and then runs back up and the bull market continues. That's what we call a whipsaw break, and it's usually followed by a very big up move. And I could draw some more in for you right here. You can see all the way through, we get the whipsaw move and the price moves higher. The other thing to bear in mind is we've got a momentum indicator in the bottom panel. And that momentum indicator goes below zero, or gives sell signals when it goes below zero. And you can see that's what happened in these three instances. And in all the 13 bear markets that we've had since 1959, all of them have experienced at one point or another a negative crossover by the momentum indicator. Sometimes it's a tiny signal, as this one just here at the beginning of 2001. And sometimes the timing isn't as good as was the case in 2022 and 2023. Now we're looking at the situation in a close-up period. And I'll just put in those whipsaw moves again. And you can see they were followed by a nice rally. And what we don't have is the current situation, because I've whited it out so you can't see it. So I'll uncover it now, and you can see what we've been going through in 1920 and 2025. And that is a negative moving average crossover in March. We built on that crossover in April, and then in May we bounced right back again. So in other words, it looks less like a bear market and more like one of these situations here where you get the false crossover. The other thing which makes me believe we're in one of those situations is the fact that the momentum indicator never went bearish, so it's still moderately above the equilibrium level. So that's a positive sign. And I'd like to take a quick look at the sentiment side of things. So here we have this S&P composite, and underneath is the University of Michigan consumer expectations. And it's not the actual data because that's very random. It's the 12-month rate of change of the raw data. And the idea is that sentiment swings from bearish down when it's at a low level to bullish when it's at a high level. And the idea is to try and figure out when the sentiment swings sufficiently enough to cause a change in the trend of the market. So what we have to do, first of all, is establish an oversold level or an overstretched level on the downside. And that's done at this line here at -20. And then let the oscillator come down below the line or rally from the line. And that's when we get one of these green lines up here, these green vertical lines. if you look to the right of those green lines, you'll see that rebound from low expectations from that low number and the rate of change is bullish. There are also some exceptions to that. And the red lines, there's 5 red lines, and they're all included in these, the crossovers are shown in these boxes here. And that is the fact that none of the failed signals, when they were triggered, they were all below their 12-month moving average. So right now, that indicator is at a very oversold level and starting to turn up. But because the 12-month moving average was bettered and recaptured in May, it's not the same as these red failed signals. So in fact, it stands a much better chance of being successful. Now we're comparing the S&P composite to the US leading economic indicator as published by the OECD. And these red lines show you peaks in the indicator. So in other words, after the red line, the economy starts to slow down in its growth rate. It doesn't go negative, it slows down in its growth rate. And what happens when the US leading indicator starts to turn down is this affects the stock market adversely. So in some cases, it's like a bear market. Sometimes it's a trading range. Sometimes it's a greater volatility, but it always adversely affects the market when we have the leading economic indicators start to turn down. But you notice there are 2 vertical dashed lines as well. And after those, if you look to the right of those, you will see that the market rallied. So it didn't have the same effect, but under the surface, things were changing. So what I'm going to do now is uncover another indicator, which is going to measure the sectors that have a rising momentum. In other words, bullish sectors. So let's uncover that right now. And you can see that fluctuates up and down like the economic indicator fluctuates up and down. And I should also point out that when a momentum indicator is rising, that indicates that the more and more sectors are in a positive trend, and therefore it becomes progressively easier to get exposed to stocks. And then when it's coming down, that means the market is becoming more selective. So let's just take a look at the 2004 signal right there where it peaked out and the indicator moved down. And then the indicator itself is getting lower and lower after the economy peaked, or the growth rate of the economy peaked. So in other words, although the S&P was going up, most sectors were still correcting. And we see the same thing in 1998, where was another false signal where the market went up and the economy peaked out, but the indicator showed that there was progressively less easy to make money in stocks. Now we come to the current situation, and you can see that in the last couple of months, the indicator has started to edge down, and the oscillator has also started to move down. Now that's not enough to call a recession, and it's certainly not enough to say that it's actually turned, but it has stabilized a little bit, and it's something we need to watch very carefully, especially as the oscillator is measuring the sectors in positive momentum is also declining. So finally, this is our Pring Turner leading economic indicator. And what we find is that the red highlights indicate recessions. That's the red highlights on the indicator itself. Those indicate recessions, and the vertical lines indicate their start. And if you look down at where this 2001 recession started, you'll see that the recession caller was just crossing below zero. The recession caller is calculated from the Pring Turner leading economic indicator. It's a momentum indicator, and it gives us a gauge by which to measure when the economy is weak enough that it's likely to move into a recessionary phase, because the indicator itself contains 4 different sectors of the economy. So since we can trace this back to the 1950s, and the only time that this indicator did not call a recession by going through this red line, which we call the recession line, was in 2020, which is, of course, caused by the pandemic and that recession at that time. But all the other recessions we've had since the 1950s have been called by this indicator. Now, its current situation is that it's falling and not yet calling a recession. And what you see the reason why is because the indicator itself is actually edging higher. So in summary, we have a false 12-month moving average crossover, which is bullish. If consumer sentiment has bottomed, as that indicator suggests, history suggests that stocks will rise. But there are tentative signs the US economy is weakening, but certainly not enough evidence yet to call it a recession. With that, I'll hand it over to Tom.
Thanks, Martin. Appreciate it. Also, Joe, it's great to have our talented founders of our company, and actually they did a lot of foundational work for all the models and the Pring Turner process, quality value income. Appreciate all they've done for us, and thanks for setting up the stage for us. And I'd also like to welcome new clients. We've had a number of new clients in the last 12 months, so this might be your first webinar with us, a client event that we do in the summertime, and appreciate having you all with us. So the message we're getting from Joe Martin is it's still a bull market. It's been a wild ride, kind of like that bucking bull in the rodeos. Sometimes tough to hang on, but we've held through some bumpy April and the ride back up in May. But we'll be talking about what's been going on and what we're planning on doing in portfolio tactics going forward here. This next chart might look familiar to you. We used it in our client newsletter at the end of March, so came out early April, right before the tariff turmoil hit. And at the time we were saying, it's been a rough market for growth stocks, and that would be represented by the blue, lighter blue big tech ETF, the Magnificent Seven stocks, which were down about 16% through the first quarter, whereas the S&P in the darker blue was down about 4%. But the Noble ETF, which corresponds more closely to the typical Pring Turner type investment, which has quality stocks, dividend payers with long histories of rising dividends, those had actually been up in the first quarter. So we were just pointing out that what turbulence happened in the first quarter was centered in the growth stocks. And then we'll just proceed with what happened just a week after that, going into the low after the tariffs kicked in. Everything went down, but those Magnificent Seven stocks were down about 25% year to date through April 8th. And that had a big effect on the S&P 500 because they're a very big component of the S&P 500. And that was down 15% at its low point there on April 8th. And then even quality stocks got hit too. So went from being up about 3 to down about 8% in that first week of April. And then we sent out that interim market update and talking about how a beach ball gets pushed down under the surface of a swimming pool and the pressure builds up. And once that pressure is let go, it can rebound quite dramatically and quite quickly. And sure enough, just shortly after we sent that interim update out, we did have the beach ball effect where prices rebounded, quite strongly. And the stuff that went down the most actually came back up the most. And as we finished the month of May, you would think just about nothing happened there since early February. It had been pretty quiet. If you'd left the country and gone away for a couple months, you'd look at things and say, well, gee, not much changed. Well, obviously a lot did change, and we're going to talk about a lot of that going forward. But I think the key thing that we'd like to point out is, part of that Pring Turner process is building in quality value income. And those types of stocks tend to go down less in the turbulent times. So when we get something that comes out of left field, whether it's tariffs hitting the markets or a pandemic coming out of left field and hitting the markets, these quality value income stocks, as represented by the Dividend Aristocrat ETF, they tend to hold up much better. And so it makes for a safer ride. So even though it's a bucking bronco, it's still, a less crazy ride, hopefully, for you. So Jim, do you have anything to add to that, or?
No, I think you covered that great.
Okay, well, I'll let you talk about another slide that we had presented in our newsletter.
Sure. I remember fondly my first few days in the Pring Turner office, and I was talking with Joe about all the different classes that I had taken over the years at school, at Santa Clara, And a lot of them, I was talking about finance courses. And then he mentioned, well, how about any psychology classes? Did you take any of those? And I go, well, maybe I had to take one or something like that, but why do you ask? And he goes, well, I hate to tell you this, but your education probably would have been better if you had studied psychology to go into investing as opposed to studying finance. And at the time, I really didn't understand what he meant by that. But this chart here is a great example because really, emotionally, we are not, over our years of evolution, we are not very good at investing, just naturally, because we tend to get fearful when something scares us, and then we get greedy as well. And in investing, you want to flip those emotions upside down. And this is a chart, as Tom mentioned, that we put out in prior bulletins or newsletters, and it's called the CNN Fear and Greed Index. And this goes from June of 2022 to present. And as you can see here, the higher in the chart, so the higher the number, the more greedy investors on a whole are. And this indicator takes in several different sentiment indicators, as Joe had mentioned in his part of the talk. So similar type items here. And so when you get really high up onto the chart, near 70, 80, 90, 100, that's when you're showing a lot of greed. And conversely, when you get down into low readings, single digit, 10, 20, where you see these green circles down here, that's when fear is rampant. And what we noticed here during this last decline is that the fear became really extreme and down to levels, probably the lowest levels that it's been over the last 3 years or so. And as Martin pointed out in his part of the talk, the business cycle indicators themselves held in there pretty well, in fact, but the fear just got so extreme. So that gave us confidence that, you likely have a rally ahead. And so you can see here, we had this question mark. Okay, what's going to happen next? Well, I'll show you what actually did happen. As you can see, like a pendulum, we swung from extreme fear back into, now we're back up into the greed section after having a 20% run. In fact, some people would say, hey, that's a new bull market. You're up 20%. So, we've had a strong rally, but now we're not near the levels of fear. We're near the levels of greed. So what does that mean? And what's next? And I think a clue into what's happening next would be our advanced investment barometer. And this gives us an idea of what the environment is like for the stock market out there. When you're in the green zone, green means go, it's good. Most of the time, the market goes up. There are times, however, as you see here, when you get into those red zones, where you can have some significant declines. So whether you're in the green zone, and this is where we were, this chart is actually from the beginning of the year, so at the end of 2024, heading into 2025. As you can see, we were at 100, clear skies ahead, everything looks good, we're firmly in the green zone. So if you're in the green zone, you can get a little bit extreme greed and still be okay. You might have a little bit of a pullback here or there, but the trend is still up and to the right. Well, as you can see here, to start the year, I'm going to just advance it now and show we've seen quite a significant amount of deterioration down to just about that line where we might want to start becoming even a little bit more cautious, or actually I'd even say defensive on things. So we're at an important juncture here where we are today, and Tom's going to talk about what that means for portfolios and the tactics that we've had. And is there anything else, Tom, you'd like to point out about this chart?
Yeah. Yes, thanks, Jim. I would just say that just because we touched this red zone here recently doesn't mean it can't reverse course like it did in 2023. Oh, look again in even 2011, 2018. It may not necessarily mean we're going into a full-fledged, bear market. It can recover, and we'll be paying attention to it. Obviously, the things we really want to be most careful of are something like what happened in 2008 and 9, where it went into the red zone and stayed there for quite a while, or even 2000 through early part of 2003, where prices were in a pretty much bear market for that entire period, with brief periods of up moves. So we don't know if it's going to keep heading south or if it'll reverse course, but we're obviously going to be on alert and paying attention to it. And that's one of the beauties of our investment process that Joe had outlined in the first section is, it's designed to adapt to ever-changing news and the economy, and we'll be paying close attention. But for now, what it does is it moves us from, maybe it's not all blue skies and sunshine out there. It's turned to more clouds have come overhead. Maybe it's starting to rain. And it's at a more cautious stance. So you may have noticed a few sales transactions in the account to reduce the exposure for the time being. We like to liken it to driving a car and road conditions, and maybe you can think of it as your speedometer on the car. Maybe the last 2 years we've been driving at the speed limit of 65 miles an hour or what have you. Now we're just driving it maybe down closer to 50, 55 under these wet conditions. And it could very well move back into sunshine and clear skies where we'll get more aggressive again. Or if things do deteriorate further and we get into protect mode, we would move into a much more cautious stance on the market and in your portfolios. So our sense is conditions are going to improve from here, but we want you to know that we're prepared for whatever comes our way, and we're in a position where we will move to protect portfolios further if the conditions do worsen.
Perfect. And that's a nice segue into, you mentioned getting more defensive or slowing down the driving speed, but what does that tangibly mean? And so we look at it as we have three main food groups or investment groups, so to speak. We have stocks, which are the most risky, but they'll also give you the most growth and best returns. Then you have bonds as another vehicle that can help provide more diversification. And actually sometimes during the business cycle, they can perform well, even while stocks are not performing as well. And then you have cash, which can, it does provide you some return and stability, but it also gives you a chance to take advantage of volatility and use it as an opportunity to plant new investments. So we have ranges, and this is just for a typical, we'd say conservative growth strategy. Everyone's own investments are unique and tailored to a different strategy or different risk characteristics. And so this is just a broad-based look at things in general. But as you can see, typically we'd say our railroad tracks are how we high end to low end in this type of account. Maybe at the high end, we'd be 70% stocks. And if we were full in protection mode, as Tom mentioned, we'd be, say, 30% stocks. And of that 30%, we're only going to own the highest quality, best value, and high income paying stocks. So it's really getting defensive in that measure. So it gives you an idea of roughly where you can be. Same thing with bonds. Their range is about 10 to 50%. And then cash really is what's left over when you're not making investments in stocks or bonds. Your cash is a residual investment there, but also very important to have. So to break things down, as of now, the current allocation, as you can see, it's about 58% stocks or so, 17% bonds. Of those bonds, they have a very short maturity, and they're all in U.S. Treasury bonds. So we would say that the risk, not only do we not have a high allocation to bonds at the moment, but we're only invested in the highest quality bonds. And that's by design. And as you can see here, the cash that we have is about 26%. So closer to the mid to high end of the range. And you might say, well, so what does that exactly mean? To pencil things in from where we were in July of last year, when our investment barometer was saying green skies or blue skies, green markets, blue skies ahead. We were about 64% stocks, 23% bonds, and 14% cash. So as you can see, that's what we mean by taking a more cautious approach. we're just taking a few chips off the table. And some of our bonds, those short-term maturities have just simply matured, which means we've received our par value from those bonds. And we've chosen not to reinvest into longer maturing treasury notes. We've decided to leave those in cash for the time being, and we're waiting for an opportune time to add to those types of investments as well. Tom, do you have anything else you'd want to add to this slide here?
Sure, I'd only say that the cash part is in the Schwab US Treasury Money Fund, so it's basically T-bill type investments, and that's earning a little over 4% right now. So we're perfectly happy having that extra cash earn some income while we're in between investments in stocks or bonds.
So as you can see here, we have had some changing portfolio tactics. We've already discussed a bunch of those, but we've really done some investment portfolio house cleaning, especially on the stock side, kind of taking some gains and trimming back some positions there to get into a little bit more defensive position. We've been reducing the stock allocation, as we showed on the last chart as well. And just a byproduct of raising stock allocation, we've been raising the cash allocation, and that's ready for future opportunities.
In terms of the Treasury money market funds, you might notice more transactions in your email box or mailbox. It is like a mutual fund that we have to buy and sell for you. And of course, we're doing that actively for you to put any extra cash to work at a higher interest rate, and that is around 4%. So if you notice that, you'll know why you're getting all those notices. There's no transaction cost to it. There's no tax consequence to it. It's just like a savings account temporarily. And so you might be seeing more of those notices, not to worry. And it is completely liquid, so we can have cash available for you the very next day. And just a reminder, if you are going to take a large withdrawal out of the account, larger than typical, just give us a heads up a day ahead of time that, hey, I'm going to be needing 10,000 or 20,000 or 50,000 or whatever you're going to need. Let us know, and then we can liquidate the money market fund for you to meet those withdrawal requests. Thanks.
Right. We're doing this because our main custodian, Schwab, when your cash is sitting idle in an account and it's not in one of these types of investments, they pay you a little bit of interest. It changes from account by account, but the yield on these Treasury money market funds can be up to 10 times as much as what Schwab will pay you just by having it sit idle there. So it is something we're trying to sweep as much and move as much of that money into those funds as possible, because it generates a higher return for your cash. So it's really a great opportunity to grow that cash investment over time. And as Tom mentioned, we're only investing in the highest quality U.S. Treasury investments, so they're very low risk.
Right. To summarize, it's just it's a bull market. We're still riding the bull, but we're also on alert to changes. Sometimes the ride can be pretty wild, as it was over the last couple months. But we suspect that over time, as the economy and markets and investor sentiment changes, that we'll be making proactive steps to both protect and grow your portfolio. So after a couple of really strong years in 2023, 2024 was pretty much straight up without a whole lot of volatility. This year has turned out to what we expected. We put this in the January newsletter that expect a little more volatility, and returns are not going to be as terrific as the prior 2 years, and it's playing out that way so far. We do still think we can grow your portfolio for the year, but just be prepared for the volatility, and that might mean you'll see more activity within your account for the year. But now in our 48th year as an investment advisory firm, and that goes back to 1977. I know Joe mentioned his 55 years. Well, he goes back to 1968 when he entered the brokerage business. But now in our 48th year, we've got wonderful founders and foundational characters that help build this, what we believe is a very conservative investment process. And we're certainly appreciate you and grateful for your trust and support over these last 48 years. So thank you. And I think with that, we can open it up to questions.
Thank you so much, Tom. And thank you, Jim, Martin, and Joe. So with that, I'm going to open the floor to answering your questions. The very first question that has come in, someone would like to know, what effect will constantly changing tariff policies have on the economy?
Go.
I would say it's noise to the market, because there's, as you may have noticed, it has a tendency to change every other day, or maybe 2 or 3 times a day. I do think what's important is this will not be a topic for discussion 90 days from Liberation Day, which was what, April 9th. So come July, first week of July, you can forget about tariffs, because it will all be resolved by then, or a week or 10 days before the deadline. So I think it's noise. It's not going to affect, maybe just emotionally, the change will be confusing to people, but beyond that, it's really not a strong input.
Yeah, no, I'll just add to what Joe said there. And if you remember from last year's webinar, we talked about one longer term theme that we had in mind was the reindustrialization or reshoring of jobs into the US. And whether the tariffs are settled one way or the other, this whole trend of bringing jobs back to America started probably 10 years ago. And after COVID, it really accelerated when we found out we really were, as a national security threat, we really were dependent on some foreign adversaries for our medicines and important things like steel and aluminum and so forth. So, the idea that this industrial theme that we've talked about last year is ongoing. This just reinforces it. I also believe the downside of bringing it back to the US is it's going to be more expensive to build stuff in the US. So there's kind of reinforces the inflationary tailwind that it can provide. So there's some good and there's some bad in there, but we're paying attention.
But I think one of the effects of the tariffs has actually been very positive in a negative way, because it's been able to move these sentiment numbers down to where a lot of people were bearish and got out of the market, and it's given the market the opportunity to rise from that. So it's not very pleasant coming down, but the ride up may be a lot more pleasant.
To dovetail off of that, Martin, I thought, and Joe's always told me this as well, but it's always interesting to see how much sentiment changes, but how little the economy could change. And it seemed like, as you pointed out, the economy was in a good spot going into that. And then it still was kind of chugging along, but still slowed down a little bit. But the sentiment, if you had just looked at the sentiment, you would have thought we were in a huge recession. So I find that interesting.
Yeah.
Right. Excellent. And there's another question that came in right around the same time that I'd like to kind of dovetail off of that, which is related to tariffs, in case there's any other additional commentary you'd like to add, which was President Trump seems to be all over the map regarding proposed tariffs, raising them, lowering them for some countries, postponing them in some cases. What is Pring Turner's strategy as all of this plays out?
Who's first?
Joe already covered that in his section. He's had the process, working on it for 55 years. And so we are going to change our process because of tariffs. We're going to continue to run the same playbook that we've used, and we're always trying to make it better. But I don't think the tariffs itself will change the philosophy.
Now, the news headlines change, but the human reaction to the headlines never changes. I mean, it goes from fear to greed and back and forth. And and we're paying attention to the economic indicators, and if it actually does have an effect on the economy, it'll show up over time. But for now, we're still in good shape.
I think we'll do what we always done, follow the indicators.
There you go.
Yeah.
Great, team. Next question is, we know that cryptocurrency is weird and certainly volatile, but seems to be a long-term investment rather than a trading plan. Do you regard cryptocurrency as a product or segment, or a potential investment?
I'll start. I think for something to be, there's a difference between investing in something and speculating. And the main difference between the two, in an investment, you can calculate or get an idea of what the value is of that investment that you're making. If you're buying a rental property, for instance, you have an idea of what the rent is you're going to charge. You have an idea of what you could raise rent over time, what you might be able to sell that property at. You know, you can get an idea of what your returns are. That's the same thing we do with stocks as well on the fundamental side of things. With cryptocurrency, you have a asset, we'll say. It doesn't entitle you to any future cash flows. You know, if you buy a Bitcoin, you'll still have a Bitcoin, 10 years from now, but it won't create any more Bitcoins for you. It won't create any cash for you. So it's hard to value that. It does tie in, I'd say, a little bit to what Joe talked about in terms of inflation. So I think that's one of the benefits that people see to cryptocurrency, is that you can't inflate, the government can't inflate that, or countries can't inflate it. There's a set number of it. But it doesn't fit into, at least for us now at this point, it doesn't fit into our quality, value, and income point of view. So we can't, it's definitely more speculative.
Yeah, from what I've read, the Bitcoin is something like having the NASDAQ market at 3 times leverage. It's like NASDAQ on steroids. So hasn't really stood the test of time like, say, gold has, or precious metals, which is in some ways competition with Bitcoin in terms of being a store of value. So that's one we've preferred, and we've actually done very well with it. We talked about it again last year's webinar of the streaming companies, precious metals companies, up about 50% in the last year, and a lot of that just this last 5-6 months. So that's been our, I guess, inflation play, or store of value play that's worked for us. And we actually can value those companies, and we do receive dividends from them, and rising dividends over time.
Great answers, team. All right, next question was, I received a text for this event. Is this new and normal?
That's a great question. We did just launch our texting application where we can text all of our clients just for announcements. It's never marketing. It's never anything to sell. It's just announcements when we're doing a client event. And also if the team wants to reach out to just give some information, we have a new video or something that we feel like would be of value to you, to let you know that we posted on our website, and we'll post a link within the text. We can now send that to you by text, and that was a response to a lot of clients wanting more texting and wanting more links through text, as it seems to be the way that that's what our clients were asking for. And we continue to want that feedback, and we're always going to try to bring you that technology that meets all the requirements to do that. But yes, very excited about that. We got that question, and we are excited to launch it today. If you do not want to receive text, there is that little button on the very bottom that says you can put stop, just like normal mass text. You can hit stop, and we will never send you a text again. We'll just send the emails. But yeah, you're going forward, we're really excited to be able to use this as a way to communicate with you, especially if you prefer it. So yeah.
Great answer. Thanks, Kate. And next question, mortgage rates are 7% and hurting the housing market. Will rates come down again?
They always come down when you get a recession. So the question is there going to be another recession? Well, or is it? Or can we see a recession? The answer to that, of course, is that from the last 250 years, there's always been a recession. It's a question of when and how deep the recession is. Is it a shallow recession like 2001, or is it more a deeper one like 1974 or the financial crisis? That's the big question.
Be careful what you wish for. Yeah, you can get lower interest rates, but it might come with a recession. There is a 45-year history of lower and lower interest rates that seems to have changed course to right after the pandemic, where rates hit the absolute lows. And since then, inflation has picked up, interest rates have picked up. And our belief, Joe was talking about secular trends. The secular trend for interest rates is no longer down. At best, it could be sideways for a while, but that spread between treasury rates and mortgage rates is quite wide right now. So compared to what it had been the last 30 years or so. So there is room for mortgage rates to come down at some point, even without a recession. But I think the era of extra low interest rates is unfortunately behind us. So the best we could hope for is a decline, maybe back into the fives at some point, hopefully, for you out there trying to buy a home or refinancing.
Perfect.
Yeah, I was going to say, I think rates are going up before they go down, not maybe the short rates, but the longer rates, because we're in stage 4 of the business cycle, which is the most inflationary part. So far, there's not been much inflation because the signals have been very wishy-washy, but it's always hanging out there. And if we get some kind of military exercise going on in Iran or somewhere, that would send the commodity prices up and send the interest rates up. And if the dollar is going to come under pressure, that would send interest rates up as well. But it seems that most people are bearish on the dollar. I mean, most people think the same thing. It doesn't happen. The opposite happens.
Thank you, team. Next question is, what is a piece of advice you can give for navigating uncertainty?
I would suggest psychological help. That it's actually, it's a great question, a serious one, because I do believe, my opinion, that we're going to be living with this volatility, more volatility in our future than we have in past years for a lot of reasons. But because of that volatility, it's going to put investors into that uncertainty situation more frequently. And the response that I have, and obviously we for 50 or however many, 45, 40, 50 years have dealt with uncertainty all the time. Our job is to make decisions today about an uncertain future. So how do we cope with that is we have a plan, we have a process, we have a discipline. And that's the key to dealing with uncertainty. And one of the things I would hope that our listeners out there would gain and gather from our presentations like today, that there is a discipline and there is a process that we follow, and that's how we deal with uncertainty. But it's been a long path. There's been a lot of research and effort and time in studying markets, in creating models, economic models, as Martin has, and as Jim has improved on some of these models over recent years. So, knowledge, experience, I think, are probably the greatest ways of dealing with uncertainty. But we've been doing it every year for almost 50 years, and we're still around. Maybe a little brain damage, but that would be due to other reasons. I hope that answers the question.
I just add there, I think that was a great response, Joe. that you need to embrace uncertainty because it's going to be out there, and you can take advantage of that uncertainty. Markets hate uncertainty. That's why the chart that Tom showed earlier, when the markets just went into a free fall for a week or two because uncertainty was really high. But you have to understand that there's a difference between uncertainty and risk. And so you can judge those two things. And sometimes you'll get a situation where the uncertainty is quite high, but the risk isn't as high. I'd say that this last drawdown was a good example of that. The economy was still going okay. People got caught up in the moment, but you could think, well, they could also just reverse course on this really quickly. It was kind of man-made in a sense, that fear. So maybe the uncertainty was quite high, but the risks weren't as high. Now, there could be other scenarios where the risk is higher than the uncertainty, and that's a different story. But I think you just have to embrace it and know that there's always going to be uncertainty, as Joe mentioned, and just plan for it accordingly.
Great answers, team. Those were awesome. And another person would like to know, why did you sell some precious metal companies? They keep going up.
Yes, well, they did so well, they became a larger and larger piece of your portfolio. So part of our risk management is to rebalance a little bit and take some chips off the table when an asset really has gone up almost parabolically here in the last year. And maybe folks are getting a little greedy in the precious metals market here recently, so that might be a sign just to take some off. We still are gold fans and gold bugs, so to speak, precious metal fans. So we still retained a good portion of it. We're just taking a little bit of chips off the table so that as we've reduced other things in the portfolio, it's not an even bigger oversized position than it was earlier. Hope that answers the question there. But I mean, if it were to pull back, we could certainly be looking at adding to it again.
Mm-hmm. Perfect. Thank you, Tom. And another question, what things keep you up at night as an advisor in this kind of a market?
Who's not sleeping at night? Katie sleeps at night, I know that.
I sleep like a baby. I wake up every couple of hours and cry. To me,
always something to worry about.
Yeah, there's always something to worry about. But to me, the biggest concern I have is the change in market structure over the years that is really being driven by the growth in derivatives or other instruments that are somewhat related to stocks. And I think that's a concern to me, is what's been going on that we don't see day to day. But and a good example is option activity right now, which is a leveraged way, again, a derivative and a leveraged way to approach the market. And there has been just an exponential growth in option activities, including you have options now that expire in one day. So that's the concern I have, I guess, is the derivative markets that are behind financial markets. I think the roundabout that is the quality of investments that that make up your portfolio. So there's the companies you have that have low debt and have a great dividend history of not only paying dividends but raising the dividends is the mark of a strong, superior company that will withstand all sorts of challenges and problems out there. So that's one of the things that keeps me up, but it's also why you have so many layers of risk management built into your portfolios. You can ask Tom or Jim, for the next couple of hours, and they will bring up another layer of risk management and another layer. So that's the thing that keeps me up at night. But I think that we have an answer to that to that issue.
Yeah, and I'd have to say we're all paranoid investors, and that's why we built an investment plan where we can sleep at night, and we do, and we appreciate your concerns from time to time, and we're always here to talk with you. If you become fearful or concerned, we're glad to go over things with you and re-explain our process, or if we have to make adjustments just for your situation, we're glad to do it.
I'd say one other thing just to add, I wouldn't say it keeps me up at night. I think it's an interesting dynamic, and Joe touched upon this on his about the market being a little bit overbelieved or overvalued. I think part of the reason why that's happened is because you've seen, and we didn't touch upon this, maybe we need a whole separate webinar to talk about it, but you've had this long-term trend of money going into passive investments and lots of money flowing into passive investments. And by definition, if you're a passive investor, you don't look at the valuation, you don't look at, you're just buying an index and you don't care what the price is you're paying for that. I'd say one thing that concerns me, and you finally reached a point where now more than half of the assets are passive, and that's continuing to grow every day. So that can't continue forever. So I wouldn't say that. I guess the concerning part is if that continues to run up, you could see one huge, I don't want to say bubble, but overvaluation in the markets for certain things. And so what would worry me is that everyone thinks that they're a genius, like Joe did when he picked all the most active stocks, and then they take too many risks at the wrong time. But on the other side of that, if you can survive that, and if you're actually the last value investor out there, I mean, that'll be like going to heaven, right? Because every dollar is going to is passively invested. And if you're the last person actually looking at the valuations and seeing what's out there, I mean, there's going to be plenty of opportunity. So I don't know if that necessarily keeps me up at night. It's something that I'm watching that could, there's lots of ways that it could play out. It could form a huge bubble where everyone just thinks they're geniuses again, similar to what happened in the late 90s. And that didn't end well. But Pring Turner made it through that time frame. Clients made it through that and were able to enjoy the next run up. So that's a possibility something could happen out there.
Awesome. Thank you, team, for your amazing answers. I am going to begin wrapping up the event. Unless anyone has a last minute question you'd like to pop into the Q&A feature, we will gladly get to it right away. If not, thank you so much for being here. I have seen legendary clients here and new ones, and that is just wonderful. And again, even if you're just watching this as a recording, we appreciate each and every one of you. Thank you for being here. You are why we come to work every single day with a smile on our faces, and I genuinely mean that. And to the team, thank you for just a fantastic event, and I hope that everyone has a wonderful summer. Bye.
Bye.
Thank you.